All right. I think I should introduce the session. Just thank you. So, welcome everyone to this session on the challenges imposed by climate change. My name is Conny Olovsson, and I will be sharing this session. Yeah. Without further ado, let's start with the first speaker, Giuseppe. Please go ahead.
Thank you very much. So good morning or good afternoon, everyone, depending where you are. So I'm going to present, first of all, let me say, I forgot to put the disclaimer. The usual disclaimer applies. Everything that I'm going to say should not be interpreted as the view of the Federal Reserve System. So what I'm going to present today is part of our research agenda that studies the role of microeconomic heterogeneity for the aggregate economy. Now, there are substantial differences that we observe within industry in the characteristic of producers. And just to name a few, think of the age of the capital stock, but broadly productivity levels. So here in this paper, we actually study the role of this heterogeneity for economic policy. Policies often target certain characteristics of the firm. For instance, you can think as policy aim at the size or policy aim at improving the efficiency of certain producers, and it's going to give direct incentives for firms to actually adapt and change these characteristics over time. So here we actually analyze how carbon taxes alters the incentives that are faced by firms to adopt more efficient and less polluting technology. And after this kind of brief introduction, let me give you a little bit more of, let me talk a little bit more about the motivation for the paper. Well, there has been a range already of a wide range of energy policies at different institutional levels that have been implemented over time. There are different ways in which you can try to quantify the effectiveness of these policies. On the theoretical side, the literature has mainly employed models that feature a representative firm, which is essentially, it's a useful starting point, but essentially amounts to assuming away all the heterogeneity that we have, that there is in the data. And the issue that we tackle in this paper is trying to understand how innocuous is this assumption for environmental policy. So our goal is going to be to try to assess whether accounting for heterogeneity is quantitatively important for the effectiveness of environmental policies. And let me give you a few brief examples of heterogeneity, right? I mean, there is a bunch of paper that shows that in general emission intensities, so the amount of emission relative to the output produced by firms is actually negatively correlated broadly with TFP, the quality of management, and even size. Let me tell you what we do in the paper and what is new in our paper and how we contribute to the existing literature. So I emphasized a lot the role of heterogeneity. And here we're going to focus on a specific aspects of heterogeneity, which is going to be heterogeneity in emission intensities. In particular, we're going to show that the age of capital, the timing when capital is installed at the firm level is a contributor to higher emission intensity. In particular, older capital results in higher emission intensity. And this is not surprising if you want. In a sense, this is kind of speaking to the existing macro literature that studies how new technologies are embodied in new capital goods. This is immediately gives you an example on why we should think about heterogeneity. Because if emission intensity are higher for older equipment, then when you start thinking about a flat tax on emission, then effectively the tax rate that is going to be paid by firms is going to be heterogeneous across plants. How are we going to evaluate the effectiveness of a carbon tax policy, its macroeconomic effect? We're going to formulate a general equilibrium model. the model is going to retain most of the characteristics that that you are familiar with in macro models, but it's going to be the novelty is going to constitute by the fact that we're going to allow we're going to explicitly model the timing of firms' decision to replace old old technology with new ones. And in particular, this is going to imply that the emission intensity that the firms have is going to be endogenous to the timing of the technology adoption. In the model is going to feature a well-defined distribution of firms over energy efficient and emission intensity that is going to be disciplined by the microdata. And we're going to actually show that this distribution is going to be a key object that is going to determine the aggregate effectiveness of the carbon tax in terms of output and other macro aggregates. So what are the main results? Essentially, we're gonna show our simulation indicates that the output losses due to the introduction of a carbon tax are going to be significantly smaller by about a factor of 50% relative to the one that you would obtain assuming a representative agent model. And the key is that once you have just to give you a little bit of intuition, once you have heterogeneity and essentially you allow firms to update their technology, then essentially the tax not only is going to work, is going to generate a static effect, which is reducing the size of the firm, but it's also changed the technology that is available to the firm. We're also gonna analyze a bunch of policies that are of carbon taxes that are gonna differ in their implementation. In particular, you can think of a carbon tax that's uniform, that affect all of the producer uniformly, or vintage specific with some form of grandfathering. And if the objective is reducing emission, we're going to see that actually the devil is in the detail, because depending on how you implement this policy, emission in the short run may actually increase, even if in the long run, emission may actually decrease. I'm going to be brief here in the literature. I'm gonna actually skip the literature, and I'm gonna already apologize if you're not in here, and if so, please let us know. So I've talked about microeconomic heterogeneity, and here we're gonna specifically focus on emission intensities. What I plot here is in these two graphs that I hope you can see. On the lower part, we have essentially the age distribution. It's a snapshot of the age distribution for the age of electric generators in the US in 2008. And on the top panel, it's the same picture, but it's the same snapshot that has been taken in 2018. This is just to show you how that today in the US, there are online generators that have been installed at different point in time. And essentially the idea here, we're going to use the age of the capital age of at the power plant level, and we're going to try to connect it to emission intensity. And we're trying to essentially measure how much new technologies are less polluting or have higher efficiency relative to older ones. And to do so, we're going to essentially we're trying to estimate an emission function, and in VLS we're going to regress output emission rates, different categories. We're going to relate it to the age of to the average of the plant generator. Now, something to keep in mind is that we have output emission rates at the plant level, but plants may be constituted by different generators. So their age here at the plant level is going to be a weighted average of the plant generator, of course, controlling for the usual controls. Our coefficient of interest is this beta here. That essentially is going to tell us how what is the link between emission intensities and age. And what you see here, we differentiate, of course, for input, non-coal versus coal, or the different categories, sulfur dioxide, methane, and so on. And what you see is that in general, there is a positive relationship that is steeper for sulfur dioxide, and it's a little bit flatter for carbon dioxide. So what is the take home of this slide? That essentially we're kind of emission intensities varies with age, and firms tend to pollute more the older the capital that they have. This is the insight that it's coming up from the empirical analysis. What are we going to do now? We're going to take the insight of the empirical analysis, and we're gonna use it. We're gonna embed this mechanism in a general equilibrium model. So what is the framework that we are gonna use? The backbone is still a neoclassical growth model, where technology is gonna evolve exogenously. But the novelty in the model is that we're going to explicitly account for an endogenous technology adoption decision. So let me guide you briefly through the steps. Firms, in order to produce output, they're going to use capital, energy, and labor. Now, the emission intensity, so the amount of emission that the firms produces relative to the energy that it uses is going to be endogenously tied to the technology available to the firm. The firm can decide at what point in time, by paying an upgrading cost, whether to get the latest technology or just keep the current technology. And what this is going to result with is that the energy efficiency is going to be tied to the capital vintage. Essentially, the timing at which the firm decides to upgrade, and the model essentially is going to be closed by a standard representative households that labor consumes and saves. We're going to have a government that is going to consume some final goods, and it needs to. And because of that, it's going to run a balanced budget, and it needs to it taxes the economy through labor taxes, consumption, and a carbon tax on emission. To keep things very simple, energy is going to be imported from the rest of the world, and we're not going to bother with an exogenous with a world price schedule. You can do that here for the sake of the presentation. We're going to assume an exogenous world price. Now, let me guide you a little bit into the details of the model. So the production function, let me start from the representative agent model, which perhaps is the case that we are mostly familiar with. So think of the real business cycle model or neoclassical growth model as a model in which there is no technology adoption, or it's a frictionless technology adoption and capital accumulation. In order to produce output, the firm needs to use as input a bundle of capital and labor and capital E energy. Now, the efficiency of these two bundles, I'm going to call Z, is actually is fully exogenous. Another way to interpret this is technology grows over time, and just without doing anything, essentially you are always at the frontier of the technology. Now, what is different in the model that we are formulating here? We are retaining most of the structure. So you see that the production function is the same, but now you see that it's indexed by this J. What is this J? This J measures the time since the firm has adopted the latest technology. So think in very simple terms as kind of a quality ladder model, where every period you have the decision whether you want to go to the top, so you get the latest technology. In this case, your J is going to be 0, or you want to keep your current technology, and essentially you are going to decide and essentially the distance from the frontier is going to increase over Now, an important part of the model is emissions, right? So emission, we're going to assume that in standard models, usually, or representative agent model, you see that emission is equal to energy. Here, essentially, we're going to use the insight of our empirical analysis, and we're going to assume that the emission intensity is actually proportional to the age, since you have last upgraded your capital. And in order to discipline this margin, we're going to use the estimates that we have had that we produced in the previous slides. So, what is the decision of the firm? And really, this is the only margin of the only margin that is relevant here. So, if you wanna, we're going to assume that in order to generate heterogeneity in emission intensity, we're going to assume that the cost of adoption is going to have a fixed component. This component is going to be IID, and essentially it's just a random cost that the firm draws. And the idea here is just to have a mechanism that is going to have certain firms adopt the latest technology and some other firms postponing the adoption. When you have a model of fixed cost, and the decision is not, the margin, how much to invest, but it really depends on the payoff of the two options. If the value of adopting is above if the spread between the value of adopting, the value of not adopting is above a certain cost, then the firm is going to update to the latest technology. It is profitable to do so. Otherwise, the firm is going to postpone and is going to keep the current vintage. Now, if you do that, what happens is that since the frontier is evolving, essentially the distance from the frontier is increasing over time in every period that you skip. I'm not gonna spend too much time here. It's a standard representative household with a standard budget constraints, an household that works, save, and receive some transfers from the government. Now, the government budget constraint, as I said before, the fiscal instruments are set exogenously, and we're going to assume there is only one instrument that is endogenous to ensure balanced budget. Now, the government is going to tax emission, and that's going to be part of the revenues that it collects. So I'm not going to spend too much time on the calibration here. The calibration is, if you come from the energy literature, is standard. The only thing that I want to emphasize here are two. The first one is this omega, the mapping between energy emission. We take our estimates from the data, and the other thing that I want to emphasize is the growth rate of technology, by how much the frontier evolves, grows every year. And essentially, we just, as people do in macro models, we recover it by generating a balanced growth path in which the growth rate of output is consistent with the data. Now, to discipline the micro part, another important thing is that essentially we follow the investment literature so that the model reproduces the micro behavior of investment, where you see that when firms decide to pay the fixed cost, adopt the latest technology, that's also results in a large investment episode. But this is just to say that the investment behavior of the firm is consistent with what we see at the macroeconomic level. So how do we use this model? So I told you that we're going to study the effect of a carbon tax, and we're going to consider different scenarios. First, let me tell you how the carbon tax is implemented. You start from a steady state in which there is no carbon tax, the tax rate is 0, and then you assume that the carbon tax is increased permanently to achieve some goal in emission rates. Here I'm going to report, it's going to be a constant tax over time that is going to be calibrated to achieve a 1% reduction in emissions in the long run. So I'm gonna show you 3 exercises. The first is we're going to have a tax that is common to all plants. It's going to hit them simultaneously. In the second scenario, we're going to look at a policy in which older plants are going to be exempted from the tax, or the so-called grandfathering, and then we're going to also see various revenue recycling scenarios. So let's start from the uniform emission rates. So what happens? There is the tax. There is a tax that is implemented, and now it's permanent from now on. What happens? Let me start from bringing your attention to the top two panels, the one of investors and target capital. So investors tells you it's now more expensive. Well, if there is a tax, now given the CES assumption, input are imperfectly substitutes, there is an input that is going to be taxed, right? What happens is that the size of the firm is going to reduce. So the firm is going to demand less capital. And since there is a tax now, the number of investors that decide to upgrade is actually reduced in the short time. What happens that overall these two effects contribute to reduce investments. As the number of investment is reduced, the average efficiency on a bottom left panel is reduced, and so is output, and you see that the emissions go down in the long term to -1%. So this is the case of a uniform emission rates. What happens when you have
Giuseppe, that you have like roughly 8 minutes left, and you might want to leave some room at the end for questions.
Perfect. Yeah. So let me show you what happens to the case of heterogeneous emission rates. The propagation mechanism now is quantitatively different. What is happening? Once you increase the tax, given that you have this unequal incidence, now firms with old capital are actually going to, it's going to be much, you are tilting that, you are penalizing people with very old capital. As a result, the number of investors is going to increase, reaching a peak of about 2% before actually setting up at a higher level. Investment is reduced, but less than before. And why is that? Because now the economy is more efficient. Essentially, next to the usual static effect where you are taxing one input that is perfectly substitute, now there is the other effect, which is the technology adoption, this dynamic effect that makes the individuals adopt better technology, and this mitigates the effect of output. Now the reduction in emission rates is the same. The only other thing that I want to show you is the case of grandfathering. And I don't have much time left, but I want to bring your attention to the panel that displays the emission. So the blue line tells you about the case in which the emissions and there is proportionality between emission and age. There is no heterogeneity in a sense. What happens? Why emission increase in the short run, even if you have introduced a carbon tax, but you have exempted old capital from the carbon tax? Essentially, you are making old capital more valuable, and by doing so, people hold on to it. And by holding up more, essentially the efficiency of the economy is reduced, and by the fact that the economy is using dirtier capital, more dirtier capital, is not upgrading as before, the emission actually in the short run increase. So conflicting with the goal of the carbon tax. And this is just to say that the way you, what the simulation suggests is the devil is in the detail, right? So the details about the implementation of carbon tax policies are actually important for the short-term response of the economy. So let me jump to the conclusions. We have some alternative recycling scenarios, but they don't change the main message. We develop a model to account for plant heterogeneity, where the novelty is really thinking about technology being an endogenous variable, and we're not. So the way we are thinking about it, it's really more about an adoption decision rather than the firm innovating. What we want to emphasize that the microeconomic structure is really important in shaping the aggregate effects of these carbon tax policies. I'm going to conclude here and take any question if there are any.
All right, thank you. Yeah, there is a question from Rick. I think maybe Rick, can you're allowed to speak, I think, so maybe you want to raise the question yourself, if you can do that.
Can you hear me?
Yes.
You can hear me. Okay, great. So this is absolutely excellent paper. It's also extremely good to have an assessment of these age-dependent effects and to see that it matters so much. So I think this is great stuff, and that's exactly what we need. I was tempted to think, because you have these fixed costs for doing different types of different age structures of technology. And given that the government policy is very fickle, we only have to think of America, that Obama was green, then Trump comes and it's all brown again. And what would your model then apply for stranded assets? I think your heterogeneous model would be a nice way to get to grips to that issue as well.
Can you repeat the second part of your question, because I couldn't hear you really well.
So basically, the point is really you have fixed costs in your model. So then people have to put things up costs and they are bygones. So then if you suddenly have fickleness of policy, so unanticipated changes, say Trump after Obama, then the question is, what would your model imply for stranded assets?
Well, here, I think the way you're going, it's something that I think as of now we cannot tackle with the present model. But I think the idea probably is that you want to have some kind of time to build, where essentially you start planning ahead, and you don't move to. It takes time to move to the new technology, and then even if you commit, what happens when I'm kind of I have built half of my plant, and then there is a policy change in there. So my guess will be that essentially that is going to. The way I interpret it using the model, there will be something like a grandfathering in a sense, so it will kind of slow down the process. Now, I'm not exactly sure about the magnitude, whether that's going to be enough. If you have an anticipated policy for a few periods, it's going to be certainly a force that works against you adopting the technology, similar to a grandfathering. I'm a little bit unsure about the quantitative detail, which one of the two forces will kind of dominate.
It looks like your model setup and your empirics would be an excellent basis to start asking that question. So
absolutely, yeah.
So thank you very much.
Thank you.
Great. We have time for another question. Glenn has a question, it seems, or if so, please ask it.
Yes, I was wondering. So economists are all in favor of carbon taxes, but does this suggest maybe the carbon tax has some challenges ahead in a real world heterogeneous situation?
I think the way we are interpreting, we interpret. So I think what we learned from the paper, which I think if you are familiar with the investment literature, is a little bit of a surprise, where essentially heterogeneity is usually, at least in this type of frameworks, tends to play no role. I think the way we are interpreting looking at different country experiences is that how much these carbon taxes, there is no one size fits all in a sense. Because depending on what is the average age of the capital or the shape of the distribution, the same policy action can actually result in very different aggregate dynamics. So in a sense, you can actually, if you have a distribution of capital that is very new with very low emission, you decide to implement a carbon tax that may not have very large aggregate effects. On the opposite side, if you live in an economy where there is a lot of dirty capital, the cost may be more substantial. So it's really about paying attention to the underlying microeconomic structure that ultimately is going to determine this aggregate emission function that pin downs the aggregate response.
But is a cap and trade more certain?
So if we experiment a little bit with the cap and trade, you can map, even in our model, you can map the cap and trade. You can map the cap and trade in the carbon tax. Now, what is really what is hard there? So if you're thinking like, how do I measure emission intensity at the firm level, for instance, in terms of the implementation of the carbon tax? So in our framework, there is an equivalence between the two. You can always map one into the other. Now, when you start thinking about implementation and whether a carbon the cap and trade will be a more efficient way to allocate resources without really having to distinguish at the firm level how much each firm is polluting. The basic mechanism is going to be the same whether you do the cap and trade versus the carbon tax, I think, because it's okay. Always about how many permits you need given how much you are polluting, and that's creates heterogeneity if you have different emission intensity.
Okay, so Giuseppe, I'm afraid we need to switch speaker. Thank you very much. So no, it's okay. But the next speaker is Steffen Hitzemann. So.
All right, thank you so much for having me. I assume everyone can see my presentation now at this point, right? Okay, so I think that is the case. So I'm presenting today the paper Understanding Macro and Asset Price Dynamics During the Climate Transition, which is joint work with Michael Donadelli, who has just moved to the University of Brescia, Patrick Grüning, who is at the Bank of Lithuania, and I'm at Rutgers University. Of course, the usual disclaimer here applies. So this is our opinion, not the opinion of the Bank of Lithuania. Or the Euro system necessarily. Okay, so what is this paper? What is this paper about? So it is basically, I mean, of course, also a paper that looks at the transition to a low carbon world economy. In that sense, it's similar to the paper we just saw by Giuseppe, but what we are focusing much more on here is the financial markets and the relations between the financial markets and the macroeconomy. So obviously the transition to a low carbon economy is not only driven by actually implemented policy measures, but also by expected policy measures, and financial markets basically provide signals for that, obviously, and then macroeconomic capital ideally follows according to Q theory. So this is as standard as it is, but we're going to look particularly at the climate transition. So and the interaction of asset prices and macroeconomic quantities during those times for the next 50 to 100 years, I guess. So now we have three main questions. So the first one is actually an empirical question. So in some sense, very simple. So has the US stock market started pricing the climate transition, right? Because this will already provide us with the first kind of intuition. Does the financial market give the correct signals for the reallocation of capital in here? And then we're going to go to a model for the climate transition, basically. And the question is, how do asset prices and macroeconomic quantities in these different sectors behave over the climate transition? And as finance people, macro finance people, we're particularly interested in this decomposition of cash flow effects and risk premia, right? And then, of course, in the feedback effect of risk premia also from financial markets to the macroeconomic quantities during the climate transition. And one main takeaway from this presentation should be that we're going to highlight a risk premium channel of climate policy. So this is actually, this will come later in the slides, but this is one of the main takeaways that we want to have in here, something that we call a risk premium channel of climate policies. So let's jump first into our empirical analysis to see what we have here. There is actually also quite some literature already who wants to analyze from a finance perspective, basically, do clean firms or do dirty firms, if you want to say it like that, or brown and green firms have higher returns than the others, right? And this is, of course, very important if you look at the allocational role of financial markets for macroeconomic capital and the informational role of financial markets for that. So 2 papers by Bolton and Kasperczyk find actually that firms with higher CO2 emissions earn higher returns, right? So in my simple language, this means return of dirty firms is greater than return of clean firms. And of course, this can sensibly not really be a cash flow effect, right? Cash flows should basically go more towards the clean firms. So they basically say this is a carbon risk premium, right? And this is why the dirty firms earn higher returns already as of now. So now interesting in the literature is there are papers who find exactly the opposite. They actually look at pretty similar sample periods. So this paper, an investment strategy of long carbon efficient firms and short carbon inefficient firms, would create strong positive abnormal returns per year. So you have RC greater RD in here, clean returns greater than dirty returns. And this is also what another paper finds, returns of clean firms greater than returns of dirty firms. So now, I mean, the big question is, yeah, so what's the difference between those papers? I mean, there are some differences in sample periods and so on, sample selection. And one main difference or one main issue in this literature is also that you have, of course, classification issues, right? So what is clean, what is dirty? You have scope 1, 2, 3, and so on. So now, you know, just to get things straight in here, we want to, you know, take a very simple approach, but then tease it out very clearly. We will just focus on the fossil fuel / oil sector for our empirical analysis to ask the question, okay, what have financial markets priced in terms of the climate transition? Because if there is one sector that is, of course, yeah, obviously affected first and most importantly by the climate transition, then it will be the fossil fuel sector / the oil sector. And this is why we take a simple approach so we don't have to deal with these classification issues in here, just to get kind of a first, yeah, impression, where are we standing in terms of the signal that's coming from financial markets. So now actually, if we make it too simple, then we're not going to get any informative results. So if we just look at returns of the oil minus market portfolio, so they sometimes, you know, decline, then they go up and so on. So there are actually some papers out there that they say, okay, first of all, returns here declined due to a cash flow effect, and then subsequently you have higher returns, and this is then a positive risk premium. But this is, of course, I mean, this is just interpreting it into the picture. This is not very informative in here. The same thing if we look at price dividend ratios. From the point of view of price dividend ratios, historically, we would actually say that the oil sector is valued pretty highly in here. I mean, the most recent episode with the current COVID crisis, we don't have it in the picture here yet, but in this historical view, we would say, yeah, actually the oil sector is valued quite highly. So this is also at the same time not very informative because it doesn't take into account market-based factors and so on. Just wanted to show you that as a small motivation. So we take a sound empirical approach to that, similar to, you know, other people from finance literature that ask these type of questions for other areas that ask, for example, are large banks valued more highly by the market and so on. So we use market to book ratios as a valuation measure, which has better properties than price dividend ratios. And we employ a whole panel regression setup in which we can control for a lot of important control variables. And now the main question is, okay, has the oil sector's financial market valuation changed with the increasing awareness for climate change risks, right? So for that, we need to, of course, define what is the increasing awareness for climate change risk. For that, we take an approach where we basically construct something that we call a climate change risk awareness index. So this is, other people also do that in some papers in a textual analysis way. We base it here on Google search volumes and Google Books. And our climate change risk awareness index looks like this blue line in here. So basically it shows a clear trend, right? So, and it also makes sense intuitively. The awareness for climate change risks have gone up since the 90s, then particularly since the 2000s, also influenced by the introduction of the Kyoto Protocol. And this is basically a trend that we're seeing in here. if we compare it to other indices like the environmental policy stringency in the US as published by the OECD, then you also see, yeah, that it's going parallel. And we see a clear trend in here, which also makes sense intuitively. So then we're going to look at the whole universe of CRISP CompuStat data. So this is basically all important US firms, 4,000 firms on average, sample period from 1970 to 2018. It doesn't include the most recent episode. We have a number of control variables, and now we want to know if the evaluation of the oil sector changed along this trend in climate change risk awareness, right? So to be precise, we're not so interested on these small variations that we have here around the trend. I mean, in previous presentations, some people have also asked, can we correct for this trend and then basically look at these small variations around the trend? Yes, we can do that. But here in this paper, we're more interested actually in the trend in climate change risk awareness and see if there is a similar trend in the oil sector valuations. So here, this is basically the result. So this is a panel regression for the whole, again, CRISP CompuStat universe. And we have, in this case here, we have an oil dummy standing for the oil industry. We have the climate change risk awareness index, and we have the interaction dummy between the two, right? And we have a bunch of control variables, the cash ratio, debt to assets, size basically of a firm, R&D, and so on. So this takes into account market-wide trends, of course, and market-wide control variables. So what do we find as a result? So particularly the oil sector relative to other firms in the universe has declined in terms of the market to book ratio. And here you can see how much has it declined. So the coefficient here is 0.015. So this is basically per percentage point increase of the climate change risk awareness index, right? So if I go back looking at the climate change risk awareness index, this has basically increased, let's say, since 2000 until today by about 100 percentage points, right? So it's normalized actually here in 2014 to 100%. So that means that coefficient of 0.015 translates to a drop in the market to book ratio of the oil sector in financial markets relative to the whole universe of firms by 1.5. So this is now not percent. So this is basically the market to book ratio has declined by 1.5. And the average market to book ratio of the oil sector is between 3 and 4, right? So that means basically the valuation of the oil sector has declined by between 30% and 50% in the last 20 years. So this is what we find in here. This is actually the same if we look at all fossil fuel firms, right, which would include the oil sector and the coal sector and yeah, certain other basically firms that are a bit in between that do both of it. And this is what we find in here. So in that sense, the financial markets have devalued oil firms in the last 20 years, which can be interpreted because it's going very much parallel with the increase in climate change risk awareness, can be interpreted as the financial markets are taking this into account, both implemented policies and also expected policies in the future. Just very quickly, why is our approach in that sense more powerful than just some very simple analysis? I mean, we see here, if we go back to the price dividend ratio, that we don't get this result in here. We basically see, yeah, since 2000, they've been pretty stable, or historically, they've still been at a pretty high level. I mean, what is the case in reality is that since the 2000s, basically, the price dividend ratios of the whole market have increased quite a bit, right? And the oil sector is lagging behind relatively, right? And this is basically what explains this drop in the market to book ratios here relative to the whole market, right? So this only applies if we account for the market-wide trends. Otherwise, we would not get this result. And another thing that is actually quite interesting empirically, we can run the same setup, but we don't use the climate change risk awareness index, but we use simple yearly dummies. And we basically plot the oil market to book coefficient of this panel regression here with yearly dummies, okay? And then basically we compare it to the real oil price, right? So the real oil price is obviously always a good indicator for the future revenues and also for the market to book ratio, the valuation of an oil firm. And it used to run pretty much in parallel until the 2000s, right? After that, the market to book ratio of the oil sector relative to other sectors dropped, while the oil price actually increased for a while here during this commodity price boom. Then it dropped, but still there is still this wedge that exists basically between the oil market to book coefficients and the real oil price that has basically started appearing since the 2000s. And yeah, another way to analyze this is that the correlation between these market to book coefficients and the oil price used to be 0.52 and highly significant from 1970s until 2000, while the correlation between the oil price and the market to book valuation of the oil sector has dropped to almost zero and insignificant from 2001 to 2013. So overall, in this very simple results here, just focusing on the oil sector, but we just actually wanted to pin it down. So the financial markets have taken into account this climate transition, right? So they have clearly devalued the oil sector. And you would not see that if you just look at the oil sector in isolation, right? So we need to control for all these other things, especially market-wide factors, and also all the other control variables to basically pin down this result for the US financial market. Okay, so starting with that, so now we're interested in how would things basically behave over the climate transition, right? And then we're gonna figure out one thing from our economic model that we call the risk premium channel of climate policy, which I'm gonna talk about in a second. So we have a model for the climate transition. So it's a bit similar to integrated assessment models, not exactly the same, but so we have a household that consumes basically dirty goods, consumes clean goods, and consumes also environmental quality X, right? And okay, what makes the dirty firm a dirty firm is that they basically consume oil and fossil fuels, right? That are produced by the oil producer. The dirty firm has obviously greenhouse gas emissions. Those emissions lead to an increase in world temperature, and the temperature negatively affects environmental quality over time in line with the Nordhaus damage function. And because this is obviously an externality that the dirty firm does not take into account, this gives rise to a carbon tax that is set by the regulator, right? So pretty simple. This is basically how the model looks like. To provide a few more details, so this is, I mean, we're going to talk about asset prices and so on. So this is designed in the style of macro finance models. So we have Epstein-Zinn preferences. We have an intertemporal elasticity of substitutions greater than 1, actually of 2 in our very baseline calibration, which is a bit of a debate, of course, in macroeconomics. In finance, this is what people use nowadays. We also look at different calibrations to see the differences in here. We have, as I said, a Nordhaus damage function. And now we do something similar to what Giuseppe also did in his model. So we're going to initialize the model at a pre-transition state, right? And then basically model the transition to the full model equilibrium. So our pre-transition state is in the year 1995. And in this state, we, for simplicity, basically say that agents assume that the effect of emissions on temperature is 0. Right? And correspondingly, if you assume that, you would also get an optimal, socially optimal carbon tax in this scenario that would be 0. And this is basically our initial state in here. We could also do that for different years if we don't believe that for 1995. This is what we did here so far in our model analysis. And now what we're going to do is we look at the transition towards the full model equilibrium, first under the scenario where the carbon tax is set optimally, and in the second scenario, where the carbon tax slowly converges towards the optimum, as we would expect it in reality, right? In reality, I would say the regulator is always lagging a bit behind, and therefore this second case is a bit more realistic in here. And what we also want to do, so I will show you the climate policy risk premia and what we call the risk premium channel of climate policy in here by looking at the conditional impulse responses for different states in the model. If we have particularly low taxes, optimal taxes, or high taxes, and we will see that there is quite some state dependency in terms of these risk premia and then also the feedback effect to the macroeconomy. So first, just some reality check. Does the model work well? And actually there's, the first point is that under Epstein and Zinn preferences, right? How does the optimal carbon tax look like over time? There is a paper by Daniel, Litterman, and Wagner in PNAS that shows that if you have Epstein-Zinn preferences, it's actually a bit different to integrated assessment models, right? So there it is typical that you would jump up quite a bit already in the beginning, and then you have a bit of a hump shape later on. And this is actually also the case in our model, right? So with Epstein and Zinn, you start at a pretty high carbon tax.
Put me in the head.
Excuse me? Okay, so
Let me say that you have basically around 8 minutes left, so you know.
Oh, I see. I see. Thank you so much. Okay, so we have basically this behavior in here for the optimal carbon tax. So this is basically like a relative number here. So if you look at the quantitative magnitude, if you actually compute it, then under Epstein-Zinn preferences, you get something around $150 already here in the beginning. So this is a pretty steep increase. So just as a reality check, if we have a lower intertemporal elasticity of substitution, then we actually get something that's much more similar to the standard integrated assessment models. So this is still not yet constant relative risk aversion, right? For that, our IES would have to be even lower, but here we get the typical increasing shape that we also see in integrated assessment models. So now what we actually assume, so we said we consider two scenarios, the optimal tax and a scenario where things slowly converge towards the optimal tax. This is here in blue, right? So we start very low and then we basically slowly converge over the next 100 years towards the social optimal tax, which also means that the optimal tax going forward in this blue scenario is always a bit higher, right? Because we're already missing out, we're not setting the optimal tax. That means the optimal tax going forward would always be a bit higher than as if we had put the optimal tax already from the beginning. Okay, so the other things basically behave as expected. So because of the introduction of the carbon tax, emissions decline, temperature rises, and environmental quality declines. Here we already see how much we're losing because we don't set the optimal tax from the beginning, right? So we have this like slow drift towards the optimal tax. So this basically translates, while in the optimal scenario, we can keep it at a temperature of 1.5, almost increase. Here we're going much more towards the 2 degree scenario in here, right? So this is what we see in here. This is basically just a reality check. And now also for financial markets, in terms of Q theory and so on, the model works as as expected. So what is happening is that the Qs, basically the Tobin's Qs of the, in the beginning of the transition of the dirty sector and of the oil sector strongly decline, and the Q of the clean sector increases a tiny bit, right? In terms of financial market returns, we have strongly negative returns in the dirty sector and the oil sector, and we have positive returns in the clean sector. And now this actually triggers, as we would like it from Q theory, a reallocation of capital towards the clean sector, right, and away from the dirty sector and the oil sector. So this is so far as expected, right? So basically the financial market, by anticipating this transition, provides a signal in here that tells us that macroeconomic capital should be reallocated towards the dirty sector, from the dirty sector and the oil sector towards the clean sector. So this is basically as desired in here. One important thing for financial markets is, of course, that we would expect over the climate transition that the Tobin's Qs, or the valuation ratios for the dirty sector and the oil sector, that they would revert over the climate transition, right? So you sometimes read commentaries where they say, we expect that the oil sector valuation will still keep dropping and so on. This is actually not so clear, because if macroeconomic capital gets reallocated, which is what we want, then basically the Tobin's cues of the dirty sector and the oil sector should actually revert in the subsequence. Okay, so but in any case, so this cash flow channel basically works the way it's expected and the way it's also desired from the policy point of view. So now the question is, how about risk premia, right? So for risk premia, we're going to look at this by means of conditional IRFs. So we're always looking at the relation here of the pricing kernel and the returns in a particular sector. And what can we say? So we want to look particularly in the beginning of the transition period. So there we are in a very low tax scenario, right? So low taxes means, if we look at this, so we're basically on the blue line, right? So we are very low relative to the optimal tax. So if we have very low taxes, then a policy shock, right? So basically a carbon tax increase, an unexpected one, leads to a decline of the pricing kernel. So what does it mean? So this is a very positive shock to the economy, because we account for more of these externalities, right? So this will be a very positive shock for the overall economy. So now, of course, we have an obvious reaction of the clean and the dirty sector. The clean sector will react positively to this higher carbon tax, and the dirty sector will react negatively to this higher carbon tax. So what does it mean in terms of risk premia? So it actually means that clean investments, right? So that the return on the clean sector is very negatively related with the pricing kernel. And that means that we will have high positive risk premia on the clean sector, right? In a financial market sense, we can say that the valuations of the clean sector will still, in the climate transition, still be relatively low, and they will be persistently quite low due to this risk premium effect, because investing in the clean sector is actually quite risky, because this is a sector that pays off well when things are going well, when the right policies are being implemented, right? And the clean sector will not do well when we have more, let's say, brown policies which are not going so well. And this is basically what we call the risk premium channel of climate policy. So this is something that I think, we should definitely pay attention to, because this is particularly pronounced with easy preferences, right? So for two reasons, we have seen that with easy preferences, Epstein's preferences, the optimal carbon tax starts at a very high level, right? So that there is a great chance that we're actually for a very long time in the low tax scenario relative to the optimal level. And secondly, risk premia are also generally larger under Epstein's preferences, right? So also the effect is much larger when policy uncertainty is much higher. And we see also the opposite here. So if we are at the optimal tax level, the effect of policy shocks on the pricing kernel is almost muted. If we have a too high tax, then it basically changes sign, right? So to conclude a bit on this point, and as I said, this is actually the main takeaway in here, or one of the main takeaways from the financial markets perspective for this model, is that, if we have carbon taxes far below the optimum, as it is the case probably right now, then this also results in pronounced positive risk premia for the clean industry, right? So that means investments in the clean industry are going to be very risky, which curbs the investments and the flows of capital towards the clean industry. All right.
Steffen, you need to conclude, I think.
Yes, so this is, I'm going to conclude. So this is not desired from a policy point of view, right? So, and in summary, we can say this risk premium channel is another reason why higher carbon taxes or other measures like cap and trade would be required today, because this risk premium channel additionally leads to a devaluation of basically the clean sector, because it makes investments here much more risky. And this is basically what we have seen in the paper. For the outlook, one thing that we I mean, the paper is still work in progress. So we want to precisely quantify the real effects, right? So in the end, there should basically be a result where we say, okay, we have a risk premium of a few percent. And because that is the case, this results in an additional temperature increase of so and so many degrees, such that the model can provide a real quantification of this risk premium channel of climate policy. All right, thank you. So I'm looking forward to potential questions.
And I can take the opportunity of being a host and ask a question. It's more like a comment. I think the way we would expect the stock market to have effects, I mean, to price in the effects on the oil industry, so to speak, would come from policy risk, really, right? You had a climate change risk awareness index or something like that. So there are many risks associated with climate change, but most of them maybe will not be important for the oil sector, so to speak. It's rather like policy that would say that we should not use oil or something like that, that would have severe effects, I think. If there is no policy, I'm not sure the oil industry would be hurt by that. Or what do you think?
Yeah, so this is also, I mean, one of the main points of the paper. I mean, let's say besides actually implemented policies, so we think that also expected policies, of course, have an effect. And so, yeah, this is, so let's say, I mean, if you expect, let's say the next, president comes from a different party, for example, or, maybe not now, but maybe in 4 years, then this is expected. And financial markets, of course, take that into account, right? So, and I mean, whatever the political trends are, I think everyone believes that at some point it becomes so forceful that the world economy has to move towards low carbon, right? And the financial markets already anticipate that today. That was one of the empirical results, right? Even in the US, right? Our empirical analysis is in the US. And therefore, this is not only about actually implemented policies, but also about expected policies.
Okay, good, very good, thank you. So thank you very much, Steffen. The next, we need to switch speaking now to Glenn Rudebusch. So,
thank you.
So this is a paper on the rising cost of climate change, evidence from the bond market, and it's joint with Michael Bauer, who's at the University of Hamburg right now, and he is on the call as well, in the webinar as well as a panelist, so he can also answer questions. Just to give an overview of the problem and the issue, this intergenerational externality. So carbon emissions accumulate and then they'll remain in the atmosphere for a century or more, and leads to high important damages that are long lasting. These higher temperatures, more extreme weather, sea level rise, etc. A cost benefit analysis, that's the method of choice for economists, would be to compare the near-term costs of climate change mitigation and the present value of versus the present value of the reduced damages for future generations. So the green here are the benefits, and the yellow are the costs, and we've got to discount those to the present. Crucial then is a social discount rate, an SDR, and there are two important features. One is the level of the SDR, and that's crucial for evaluating these long-lasting climate damages. Just to give an example, the present value of $1 billion of damages in 100 years is 138 million now with a 2% discount rate, but 4 times larger with a 0.5% discount rate. Another aspect of the social discount rate is the term structure. So you don't have a single social discount rate, but the social discount rate should match the horizon at which the various costs and benefits are realized. So just like a term structure of bond maturities, there's a term structure of social discount rates. Of course, there's a large literature on intergenerational social discounting and climate change, but this has been an area of much disagreement, and much disagreement remains about the appropriate level and term structure of the social discount rates for evaluating climate change damages. and for assessing a social cost of carbon. There are two broad approaches to social discounting: a prescriptive approach. What is the level of the SDR that's optimal or fair or acceptable? And that's often based on a social welfare theory, the Ramsey rule, normative judgments. An important example is the Stern review, which used a normative STR of around 1.4%. More common is a descriptive approach, sort of looking at what are observed real returns in financial markets. Nordhaus, for example, said, look carefully at the real interest rate, the observed real interest rate. He's not a fan of philosophical normative reflections. This is a natural approach because financial market valuations embed preferences about intertemporal trade-offs. And Nordhaus, in contrast to Nicholas Stern, uses a real rate of 4%. And that's typical. A survey of experts find that descriptive SDRs tend to be significantly higher than prescriptive ones, about 2 percentage points on average. In this paper, we're going to have a new spin on the empirical or descriptive approach, that second approach to SDRs. We show conceptually that the equilibrium or steady state real interest rate, which we call R star, anchors the term structure of discount rates. So it acts as a level factor for the term structure of social discount rates. We show that conceptually. Then we're going to incorporate R star into an empirical time series model for the risk-free SDRs. And we estimate a decline in R star in recent decades consistent with the macro finance literature. We then go on to argue that this lower new normal for real interest rates, this lower R star, implies lower SDRs at all maturities. And we infer the unobserved SDRs from models of historical risk-free rates. These are unobserved long-run SDRs. Finally, we translate those SDRs into a social cost of carbon using a damage function from the DICE model. And we estimate that the lower social discount rates at least double the social cost of carbon. So it has the reduction in R star has profound implications for climate economics. I should note, since we're at a central banking conference, of course, the decline in R star was a major part of the impetus, the rationale for the Federal Reserve's review of monetary policy that just concluded, and was a major rationale for their changing the communication and implementation of monetary policy. We're essentially finding just as important effects of the decline in R star for climate policy as that review suggested for monetary policy. There's a large related literature on discounting climate change that I mentioned. We're following what has been called the econometric expected net present value of Freeman and Groom, where you estimate a stochastic process generating future interest rates, and then under the assumption of risk neutrality, long-run SDRs equal average expected future SDRs. However, this literature has assumed a constant long-run mean R star. All of these papers shown here essentially assume that the interest rate structure is stationary, and that interest rates are going back to a sample mean. So our key contribution is a macro finance perspective that allows for a long-run trend or shifting endpoint in real interest rates, that is time variation in R star, instead of imposing this mean reversion to a fixed long-run mean. Let me talk about risk. Before I get into our analysis, let me talk about two issues: risk and which interest rate to use. But discounting, of course, depends on the risk characteristics of future payoffs. In standard asset pricing, discounting depends on the correlation of payoffs with aggregate consumption growth, the so-called consumption beta. So if climate damages tend to occur when growth is strong, that is, beta is positive, mitigation projects are of less value for society because those damages will occur during good times. So the SDR is greater than the risk-free rate. Conversely, if the damages coincide with a poor economy and negative beta, mitigation provides insurance or hedging benefits, so the SDR is less than the risk-free rate. The bottom line is mitigation projects with different risk characteristics require different SDRs. These risk characteristics are unknown, typically, certainly understudied. Our approach is to take the usual asset pricing approach. So we've got that time discounting, that term structure aspect, but we've also have this risk discounting, and in asset pricing, we're going to separate these and transform, think about transforming those risky payoffs into certainty equivalent or risk adjusted versions. And this is under the so-called risk neutral or Q metric. And we'll do this by adjusting for their systematic risk. For a positive beta, the risk adjustment lowers the certainty equivalent payoff relative to the real world expected payoff. Additionally, some stochastic payoffs are riskless because they're uncorrelated with future the real stochastic discount factor, real interest rates, or marginal utilities. So once you have that transformation, then you can discount the risk-adjusted payoffs using risk-free discount rates estimated from rates of return on risk-free assets. So these are the YT here is the certainty equivalent discount rate in the terminology of Weitzman. And so that's the term structure we're going to be estimating. We're going to estimate the term structure of risk-free stochastic discount rates. These are going to be the SDRs suitable for discounting certain or certainty equivalent future payoffs. One more preliminary is which empirical market-based rate of return to use. We're going to use government bond yields as a source for determining descriptive risk-free rates. That is, from the title, evidence from the bond market. Certainly from the perspective of financing public policy action is the government bond rate that's an appropriate cost of capital. Government bond maturities, however, rarely extend beyond 30 years. So we're going to derive these long maturity SDRs from an econometric interest rate model fit to the data. Some have also, alternatively, some have used an estimate of the economy-wide return on productive capital, sort of stock market evidence in particular as a measure of the social opportunity cost of capital. However, there are a variety of factors that have led to a divergence, sort of in the private rate of return. Greater risk premium, market power, unmeasured intangibles have all widened the divergence between the rate of return that savers earn and the private rate of return onto capital. So we find it less compelling to use that as a source of the SDRs. Finally, there are also issues of measurement of this economy-wide real return of productive capital that make it, I think, less compelling to use. So let me turn now, those are sort of all preliminaries. Let me turn now and talk about what we're doing. Of course, the R star is this equilibrium or long run level of the real short rate. R star determines the level of the term structure of real discount rates. So here you can see the long rate at time t of maturity n that can be decomposed via the expectations hypothesis. Z is a convexity term, decomposed into R star plus the cyclical term, and again the convexity term. So our tilde is just the cyclical deviation of real rates from R star, the real short rate from R star. The key results to take away from this is that while short-term real interest rates are affected by current rates, long-term real interest rates are lowered by convexity, but all of the SDRs move one for one with R star. So all of these, whatever the maturity, they're all dependent on shifts in the equilibrium real rate. There are a range of estimated estimated declines in R star from the literature. Here we've got 5 studies from the literature. The estimate of R star during the 1990s, the estimate of R star during the 2010s, and you can see that we've gone sort of from a 2% to something just below 1%, and that's a 1.3 percentage point decline in R star. We're going to estimate a UC model, an unobserved components model for the short rate, for the 1-year rate. And that's going to give us very similar results, and that's going to be the model then that we use in our calculations of a social cost of capital as well. And let me go into that model a little bit. So this unobserved components model is quite simple. Short rates equal the equilibrium rate plus the cyclical deviation. That cyclical deviation has a stationary process, and R star is given by a random walk. We use annual data on the real rate and Bayesian estimation. The priors are generally uninformative except for a tight prior on this UT in order to avoid an overly volatile R star, and that's typical literature. So the model provides new estimates of R star and a term structure of risk-free social discount rates based on the time series of real interest rates. This is what our R star estimate looks like. The blue line is the R star, the black line is the observed 1-year real rate. And you can see we're going from somewhere in the 2s around 1990 to somewhere just below 1 at the end of the sample in 2019. And that's going to be consistent with, as I mentioned here, this bottom line, that's consistent, you know, close to what the average in the literature suggests. We've got a few different additional models for robustness. We estimate an unobserved components model for the 10-year real treasury yield. We have a state space model that separates, that has 2 trends, one for inflation and one for the real rate, sort of a pi star and an R star. And there we use the 1-year nominal yield, inflation, and inflation expectations. We also considered an alternative model without a random walk, and this is just a mean shifting AR1. So this is similar to what the previous literature had done, except here we allow for a downward shift in the mean. So they've got an autoregressive process, but as you can see in this picture, there's been this downward shift in where real rates are going to go, and we fit that by allowing for a different mean before and after 1995. And we can estimate this for the 1-year and the 10-year real rate. These are all 5 of the models that we consider. These are the estimates of the equilibrium real interest rate in 1990 and the estimate in 2019 and the change in percentage points of those estimates. And you can see we're all, you know, on the order of 1 to 2% for a change in R star. Now we're going to use these models to calculate a term structure of SDRs. So we've got the, with the model, we can calculate a model implied term structure and quantify this shift. So we assume risk neutrality to obtain a term structure for the short rate, and then we have a simulation approach to solve for bond prices or long rates. We're going to use the point estimates of the parameters and the time t state variables. So we've got the point estimates of the parameters in 1990, the point estimates in 2019, and then we apply that to a given set of state variables starting in 2000. And so we've got a similar sample point. We're really just examining the difference in R star, the difference that the drop in R star makes for estimating these. We do have a shadow rate specification, so we rule out negative social discount rates. And then we just calculate the term structure of SDRs quite simply in that way. This is what the results look like. The dashed lines give, so this is from the unobserved components model for the 1-year rate, and the paper has it for the other 4 models. This was the estimate of R star in 1990, just below 2%. This is the estimate from the model in 2019, just below 1%. And you can see how the term structure of SDRs has shifted down. These deviations from R star reflect convexity effects. Here we're going out from 0 to 400 years, so a 400-year ahead social discount rate to take into account those long-lasting damages that I mentioned. Given those that term structure, those 2 term structures of social discount rates, we then can calculate a social cost of carbon, assuming the 1990 term structure and assuming the 2019 term structure, and assess how that changes. The social cost of carbon is the present value of all of future damages, that's this marginal damages, MD, from an additional ton of CO2. So this is the social cost of carbon. Here we've got the discounting, and here are the marginal damages. So we need two ingredients, 2 factors to calculate this social cost of carbon: a term structure of discount rates, and I've talked about how we're using the model-based term structures from 1990 and 2019 for that, to construct those. And then we need the future marginal damages, and we take those as given. We're just going to use estimates from integrated assessment models, or IMs.
Glenn, so let me just say that you have roughly 8 minutes, and that should also include time for questions. So,
excellent. The estimates, the future marginal damages we take, our baseline, our benchmark case is just to use the DICE model developed by Bill Nordhaus. This is similar to what Newell and Pizer did. It gives us marginal damages over the next 400 years. For robustness, we're going to look at a more recent vintage of the DICE model, DICE 2016. We're using DICE 1994. And then an improved version by Simon Dietz and co-authors that has a different physical dynamics. The DICE model is deterministic, like many IMs, so in principle then a risk-free real interest rate is completely appropriate for discounting in this model. So our lower empirical SDRs boost the social cost of carbon. Here are our estimates of the SCC using the damages. Again, the model our benchmark model is this top line. Just to remind you, it had a change in R star of a drop in R star of 1.2 percentage points. It calculates the social cost of carbon as $31.80 in 1990. Using a 2019, using the new term structure, not the 1990 term structure, but the 2019 term structure, taking into account this drop in R star, the social cost of carbon goes up to $68.70, and that's essentially a doubling of the social cost of carbon. And that doubling just occurs, the only thing that has changed, we haven't moved through time, the only thing that's changed is we've accounted for this drop in R star. And that's true for the other empirical models we've got, the 10-year rate, the state space model, and the mean shift as well. Just to conclude, so macro finance shifts are important for the economics of climate change, and I think underappreciated. The secular decline in R star lowers all discount rates and substantially boosts the social cost of carbon. In the past, SDRs from a descriptive approach, that is the market rate approach, have been significantly higher than those from a prescriptive approach, typically this normative judgment. And our results bring the approaches in closer alignment, in particular lowers the descriptive SDRs toward the prescriptive ones. Something we're thinking about for future work is the interaction. So we've really just taken the change in R star on its own to see what how that affects the cost of assessing the cost of climate change. But of course, future climate change may lower the equilibrium real interest rate further, and a deeper understanding requires a joint modeling of macro finance trends and the economy and the climate system. So that's something we're thinking about next. Before we go to questions, let me just also put in a pitch for the virtual seminar on climate economics. The next one is tomorrow by Esteban Rossi, and I think it's going to be probably at 4 p.m. London time. Thank you.
Perfect, Glenn. Thank you so much. Yes, so any questions?
Hello, Glenn. This has been a great paper. Now, what you use is the certainty equivalent value of the rate of interest, which then leads to declining term structure. Have you looked at also at other models of a declining term structure? For example, they may have pessimistic or optimistic expectations. Other people have used it in the literature.
I'm not sure which models you mean.
For example, Christian Gollier, for example, uses, for example, the long-run growth rate, maybe an AR1 process.
Yeah, so it's important, I think, to account for the potential shift in the long-run dynamics, and so parsing that out. And again, we've got a model where very similar to Christian's model, where there's an AR1 process, but at some point you've got to have this non-stationarity, this shift that we've got. We call it many people call it the new normal of interest rates. You've got to take that into account, and if we've got lower interest rates, that changes lots of aspects of economic policy, as I mentioned, monetary policy, but climate policy as well.
Thank you.
Did you want to jump in, Michael?
Sure. I might just add that we have a little illustration in the paper about a model like a Christian Gollier type of model with consumption growth that would correspond to a reduced firm model for real rates that has a permanent component. So basically, if you have a permanent component to consumption growth, if you have a long-run trend in consumption growth, that kind of maps one-to-one into a reduced form model where the real rate has a permanent component. So we're not really using the consumption growth model, but we're just kind of thinking about how does our permanent transitory R-star model map into something more structural.
And I also remember the very old paper, I think it's a 1977 paper by Vasicek, where you, depending on the initial interest rate, it can be declining, it can be rising, or it can even be hump-shaped. That's in a continuous time framework. So anyway, I think it's very important to explore these things because I usually ignore them and they are very important. Thank you.
We're on schedule, so let's move on to you, Rick, for the last presentation.
So we have to make do with this. This is a paper with Christoph Hambel and Holger Kraft. It's very closely related to Steffen's paper, and I must admit, listening to Steffen's excellent presentation, I feel a bit embarrassed to present this because you also are so good. For example, you got a lot of empirics, and we just have a model and do something similar to what you've done. So at least you'll be able to learn something. But I was very impressed by your paper, Steffen, and I will have to rethink our paper as well in the context of that. Another proviso is that we have a model where we don't really have a term structure of interest rates like Glenn has talked about. So in that sense, it's different. However, we do have a finance model, and it's a model, our paper is called Asset Diversification versus Climate Action. So the idea is basically that we don't do much empirics, not at all really. That's a bad feature, but we do present a dynamic general stochastic general equilibrium model which is also two sectors, exactly like in Steffen's paper. And I will probably present a bit more of the details of that, and then we can see where there are differences. And then we try to kind of price carbon, and we try to price the green and dirty assets. And we also try to look at risk premium. Again, unfortunately, not as thorough as Steffen has done. So I'm doing lots of provisos here, but that's the way it goes. So in terms of introduction, of course, we don't have to say it here, but climate is very important. There's been very little literature on finance. So the people who are talking here today are the ones who are doing it. Is of course Michael Barnett's work and maybe a few others, but not much more. Where we trying to get a finance view. Almost all of the integrated assessment literature is used one sector models, which is kind of weird. So basically you just use less or more fossil fuel, and you have less or more emissions, and that means you have less or more global warming. But of course, a lot of things is to do with structural change. So we're interested, like the others today, in the interplay between financial consideration and the policies to mitigate climate change. So we have a very modest question, and it may be silly from a finance point of view, but is the financial need to diversify assets, maybe you want a portfolio which is a mix of brown and green assets, is that helping you, or is that curbing you or hindering you in the fight against climate change? And secondly, how does climate change affect the pricing of green and dirty assets? We know from the work of Patrick Bolton and also of the more interesting work done by Steffen, where he used these linguistic data to find out that maybe certain assets have carbon risk premium in, so that maybe to hold shell assets, they need to have a higher return, because otherwise nobody wants to hold those assets. It's important to make a distinction between whether you're talking about business as usual, if you want, using the climate terminology where carbon is not priced, and optimal trajectories. Because if carbon is not priced or is very lowly priced, then of course you will get those premiums. But if carbon is priced optimally, they may disappear. And that's part of the punchline which we shared with Steffen's paper, but it's important to be upfront about it. But we really want to talk about a subtle dynamic interdependence between financial goal to diversify assets in portfolios and the environmental goal to cut carbon emissions. So we also have an integrated assessment model where we have it's like many of these models are like that. You have an economic model, you have a climate model, you have a carbon dioxide model, and then basically higher temperature leads to damages. We have 3 types of damages. I will talk about them in a minute. And then we have abatement policies, maybe encouraged by pricing. So we're going to look at a stochastic macro growth model of endogenous growth with 2 capital stocks and 2 energy sources. So the green sector takes a carbon-free energy form as input, and the dirty sector is carbon intensive. So think of the green sector as using renewable energy, maybe solar or wind, and the dirty sector is using oil or coal or gas. And a production, therefore, the dirty sector requires fossil fuel whose combustion leads to carbon emissions. So we think an important part of our story, and also to get our calibration right, but also I won't talk about it that much today when we talk about stranded assets, is adjustment costs are very important. So we think that the adjustments over time, you have these Hayashi-style adjustment costs are important also to get a Tobin Q story, again, like in Steffen's paper. But we also allow for some capital reallocation cost. So if your capital stuck in a kind of coal-fired plant, you can't really reuse that capital quickly to make a hospital or to put it in another clean sector, whatever you want to do it. Okay, so the climate model, what we do is based on this work, which Glenn already mentioned, this paper by Dietz et al., which is I'm one of the co-authors of, where we basically follow the climate science literature of the last 10 years, where basically it's pretty good approximation, assume that temperature is proportional to cumulative emissions. You don't no longer, I mean, of course, underlying it, there is a model where temperature may depend on the atmospheric carbon stock, but it turns out that the reducer model where global temperature is proportional to cumulative emissions works very well. And then we have 3 types of damages that occur. We have the normal Nordhaus damages, that's the first one. Where higher temperature leads to a higher share of damages in pre-damage output as in the DICE model. Secondly, following Dell and others who have found effects of temperature on the growth rate. We'll also allow for a negative effect of temperatures on the growth rate of capital and calibrate it that way. And thirdly, in our model, we don't only have Epstein-Zinn preferences, but we also have these Barrow-style disaster shocks. And we split up the Barrow sample into disasters that are more conventional macro disasters or wars or whatever you want to call them. And then another set of disasters which are climate related. And we assume that the intensity of these climate related disasters might increase with temperature. So each of these three reasons are reasons to price carbon. And we think that's important to look at all three of them, and we will look at them. So we would like to talk about the dynamic relationship between climate action and economic motive to diversify. So we're going to assume that initially, as it is in the real world, the economy is dominated by dirty capital, by coal and oil and gas. And therefore, there are two, I mean, even if you didn't care about climate, then we know, of course, from finance, that eventually you would run down the dirty capital stock anyway and get a balanced composition of capital stocks. But here we have two complementary goals. The first one is to mitigate climate change and just to decarbonize the economy and switch from dirty assets to clean assets. And you have to encourage it by pricing carbon. And the second is to diversify the economy, which is a diversified economy, which is a purely financial goals. So both goals incentivize the agent to actively reduce the dirty capital stock, and the speed of transition towards a zero emissions economy is amplified by the diversification motive in the first years. But over time, these goals become conflicting and a trade-off arises. Maybe that will become clearer when I show you the simulations. So from a diversification perspective, the process should be stopped if there is a balance between green and dirty capital. It comes from a theorem in finance, which we use. In our numerical simulation, it's 50-50, but it could be anyone which you think is more reasonable. But from an environmental perspective, the dirty capital stock should eventually be run down completely, or it should be run down lower to than what's from a purely diversification perspective. So our calibration showed that if you use dice damages alone, they are, as we know, they are not very high. And as Weitzman has criticized the dice model for incessantly, and Nick Stern has done it as well. The dice damages are actually also in our case so small that you actually keep a dirty capital stock alive. You don't run it down completely. Only when you allow for all these three types of damages, or if you increase damages really a lot, a bit like a la Weitzman or a la Stern, then you will actually run down the dirty capital stock completely. And otherwise you want to keep part of that open. Partially, we know it because dirty capital stocks produce a lot of output, and the output can be used to finance the green transition. So you always want to keep it open in the transition phase when you have adjustment costs. If you don't have adjustment costs, if you don't have stochastics, you immediately bring down the brown, you do the green transition immediately. You immediately switch off the brown sector and start up the green sector. But we have adjustment costs, so it takes time. And therefore you need to keep open the brown sector for some time. But then on top of that, we have stochastic shocks, and therefore you might even keep it open permanently. Now we need to do more applied work, and we will learn from other authors on how to do that. So we're giving some simulation exercises. So our main findings are that we analyze the dynamics of the risk-free rate and risk premium during the transition from a carbon census to a zero emissions economy. We use these macroeconomic disaster shocks, which we split up. Our model can generate a high equity premium and a low risk-free rate as observed in historical data. However, when you have climate change, we find that regardless of how climate change affects the economy, regardless of which one of the three channels it is, the risk-free rate, the interest rate decreases in response to rising temperature. Basically, you need to do less precautionary saving. By contrast, risk premium are really significantly affected if we allow for, if we have potential climate disaster, which the probability of them occurring increases quite strongly with temperature. Without such disasters, the impact on risk premium. Okay, so let's say something about the model. So the model is a bit stylized, and it could be improved in many ways. So the first one is we assuming an output of 2 seconds of perfect substitutes. So we have a version where they're not but here they are perfect substitutes. We have Cobb-Douglas production functions. If you stare at that production function, you see that it's got constant returns to scale with respect to capital and fossil fuels. So in a sense, it's got endogenous growth built into it. And there are two sectors, one and two, a dirty and a clean sector. And you see also that there is this lambda thing that is a negative function of temperature, which are these dice temperatures. F1 is green energy and F2 is coal, oil, and gas. And you sum these two outputs. That's what we mean by perfect substitutes. You can criticize it, but that's what we've done for the time being. So the capital stock dynamics in this model is as follows. You will see here two dynamics for the dirty and the green capital stock. They have normal macroeconomic risks captured by these geometric Brownian motions, dW1 and dW2, which are the variances proportional to capital stocks to reflect the geometric motion of the Brownian motion. But we also have these disaster risks, which are on the second line of each equations. And these are normal economic risks, like the LE, DNE, that's like the Barrow-style disasters, and we calibrate in a very similar way. But the second one, LCD, NC, these are these risks which are climate-related, of which the intensity, the Poisson risk, if you want, are temperature-dependent. You also see in these equations that you have normal-style, Hayashi-style adjustment cost, I squared over K. And you also see some asymmetric relocation costs that if you want to switch dirty capital into clean capital, you have to pay some relocation costs. You could assume that's infinite, then you have basically irreversible costs. We assume that we use that to calibrate our model. Now, there's a correlation coefficients rho 1, 2, which is the correlation coefficient between the two Brownian motions, but notice that the risks that there are also climate risks. So in actual fact, the correlation between shocks in the two sectors is in our model quite high. I'll come to that later. So this is the simple model for temperature. It's ridiculously simple. So temperature is basically a linear function of cumulative emissions. The cumulative emissions is the integral of past flows of emissions. This is what IPCC uses. This theta parameter or theta parameter, what you want to call it, is the transient climate response to cumulative emissions is about 1.6, maybe 2, 1.2, that order of magnitude degrees Celsius per trillion tons of carbon cumulative emissions. So you can read that directly from the graphs in the IPCC. And then we added some stochastics there, which is actually not so important, but we've added that. So you might assume, I won't have time to talk about it, that the diffusion coefficient sigma t increases in temperature, and that captures unpredictable positive feedback loops in the climate system. So I will not talk about that today, but that's something which we sometimes allow. So the dividends, another weakness of the model is that the dividends are an unleveraged claim on consumption. So rather than a leverage claim, so total consumption is the sum of the dividends, where the dividends are just what's left after investment and cost of fuel. There you have these, at the bottom you have this Epstein-Zinn thing, which is basically an indirect way, recursive preferences. It's actually Duffy-Epstein, I should say, because it's in continuous time. We make it a bit simpler that we assume a unit elasticity in temporal substitution with the risk aversion is of course much higher than that. And that's important. So then, this is our calibration. So we try to kind of basically, it's quite a lot of stuff in the paper on how we've done that, but basically we have this ridiculously high time preference rate, which is common in these models, 5%. It's a pure rate of time preference. I don't believe it. I think governments have low rates of time preference. If we made it lower, then our model would become, the optimal policies would become time inconsistent, and then would probably need to be supplemented with a capital subsidy. So if the government is much more patient than the private sector, so they would take a different time preference rate, as many people do. So you're not taking preferences from the markets. Then the government doesn't only want to price carbon, but it also wants to correct the private sector for not saving enough. So they will give a saving subsidy or a capital subsidy. So we abstract from that, but I just want to put it on the table there. You see that the risk aversion is 5.3 and elasticity in terms of substitute equals 1. So that implies a preference for early resolution of uncertainty. So that's a little bit like in the Daniel Litterman et al. Paper, which was cited by Steffen. So we don't have something in their paper why they get this weird result, that you really price carbon really vigorously and then it comes down, is for a number of reasons. But one of the reasons is that they have gradual resolution of uncertainty. So once a shock hits, so they don't have a continuous time model. They have a binomial tree model. It's 7 periods. But then the reason why they have this high price for carbon and it comes down is that over time, these damage shocks have occurred and you don't, well, then that's happened. So you no longer need to correct for it anymore. So therefore the price goes down. Every time you find more information, the damages have occurred. And if they have one-off shocks, then you will bring down the price of carbon. So that's an important reason for that thing. We don't have that in our model, so we don't have that aspect. So we start initial share of dirty capital about 94%. We matched a lot of the stuff in here. So the green productivity, brown productivity, fossil fuel costs, green energy costs. A weakness, although we allow for it in robustness exercises, you could allow for technological progress in these costs, which we have not, I'm not going to present you here, but they could easily be taken care of. You can even have endogenous technical progress, in which case you would also have renewable energy. And there you see these jump size parameters, and the disaster intensity parameter for the economic shocks is about 1 in 12 years. And for the climate shocks, it's also given there. So basically, that's what it is. You find that the transient climate response to cumulative emissions is 1.8. And then there are some of these emission intensity parameters which we calibrated. So, which I think are probably best to refer to the paper because it's done in a way which I think is reasonably okay. The thing we don't know anything about, or the thing we haven't really done any work on, is on this correlation coefficient between these normal geometric Brownian motion shocks, which we for the time being set at 0. So to look at the calibration of the final system, we've calibrated that in a way so that we mimic the business as usual scenario of DICE. So that's the emission path, that's the emission intensity per unit of fossil fuel, and that's the temperature path. So basically that also gives us the time, the 1.8 degrees Celsius per trillion tons of carbon, that slope of that temperature equation, and basically it also allows for some technological progress in emissions intensity. So we do that so that we want to be the model, in the absence of stochastics, it's completely comparable with the DICE 2016 model, so the latest DICE model. Then, so here are some of the simulations. So before we do that, to solve the model, we do a trick, which I'm not sure, maybe Steffen has done it as well, but we do this trick. Normally you have 3 or 4 state variables. You have a state variable for temperature, you have the state variable for capital stock 1, the state variable for capital stock 2, and then you also have maybe some other dynamics for the geometric Brownian motions and all that stuff. But we reduce it to 2. It's basically only thing you need to solve the model for is the share of dirty capital and total capital. So that means it's from solving these Hamilton-Jacobi-Bellman equation becomes a lot simpler when you do that. So anyway, that's what we did. So there's some stuff there to do it, and then this is the way it solves. So here we see three sets of diagrams. So you have a left column, a middle column, and a right column. The left column is for the DICE damages. The middle column is the one for the Melissa-Dell damages, where the damages of temperature affect the growth rate of the economy. And the third column is just what happens when you basically only have the Barrow-style climate-related disasters. They assume that the intensity of disasters that are climate-related increase with temperature. So there are three models, and then we just looked at each of these damages in different ways. So what you see in each of them, if you look at the dashed line, that's the model without damages. So you see it will settle down to about 50%. The share of dirty capital in all 3 cases. So that's the standard result in finance. And the 50% is not a wholly given, that comes from our calibration, but it settles down. But the point is that the other solid lines, they settle down to a lower level, and that's because you take account of the extra amount we take it down with, because taking account of climate change. So if you look at the black lines, these are the optimal ones in the left column for the DICE model. So you see, it only brings it down to about 30%, the share of dirty capital. So you have 70% clean capital and 30% dirty capital. So if you double or triple the damages in dice, then you get the dark gray and the light gray lines. It brings it down, but it doesn't bring it down to zero. And then you see, of course, the temperature is, if you then look at if you have higher damages, the temperature will be lower. And you also see this temperature of 3.5 degrees, almost 4 degrees. That is the optimal scenario you almost get in the DICE model. So the DICE model, nobody uses in the IPCC because it doesn't get it below 2 degrees. So that's why they all use a different thing. So
you have like roughly 8 minutes left, and again,
okay,
it should be
perfectly fine. So we have then the middle panel is then for depreciation rate of capital, the damages. So that's when that's the Melissa Dell story. There you see that if you double the damages or triple the damages, then you do get rid of dirty capital altogether. And therefore, so that's a big effect. And also you get temperature lower down. So that's because the effect on the growth rate is, of course, much bigger. And the third, on the right, the panel on the right is the one where you, the only thing you have, the only externality you have is that the incidence rate of having climate-related disasters increases with temperature. So you want to price that in. You want to price the carbon. So, but there you see that that also doesn't bring down the share of dirty capital to zero. However, if you double the disasters of that or triple, then you will bring it down. Now, if you were to put all of these three things together, and there's a case for that you should do that. I haven't, for brevity's sake, I haven't got the slide here. Then you will bring down the share of dirty capital to zero pretty quickly. So really what you're saying is that there's a clear trade-off. In the beginning, you bring down the share of dirty capital for both diversification reasons and for climate reasons. But after a while, they start conflicting. And once you've brought the share of dirty capital down enough, it's really costly to bring it down even further from a diversification perspective. And then you want to actually maybe keep some of that alive. But of course, I think if you all use all three damages at the same time, then the share of dirty capital will go down to zero, but not as quickly as it would have done otherwise. So this is part of the insights. So you can also look at these asset pricing quantities. So I'm not doing such a good job as Steffen here, and I'm still struggling, but let's look at the first panel. So the first panel, the first row for the risk-free rate. So these are the risk-free rate across the three types of damages. So the first one on the left is the DICE type of damages. The middle one is the Melissa Dell type of damage, and the third one is the climate-related disasters a la Barrow. So what you see is that the black dotted lines show the result for the business usual scenario, and the solid lines are the optimal ones, and they also show them for you see a bit of a confidence interval. But basically, what you see is that the risk-free rates drop over time if you're not pricing carbon, because basically I think because of the precautionary saving, because of that. And the thing is that by pricing it, the downward trend of the risk-free rate is much lower than it would be otherwise. So I should, in view of time, I will not talk too much about the green risk premium and the dirty risk premium, but there are some of the story is in the sense when you look at it closely, it's a bit similar to Steffen did. Not as well put as I would say as he has done it, but basically the idea is, of course, that if you're this Bolton's type of result, that you have to investors demand a premium on risky assets. That's only the case in business as usual. Once you price it, that there's no longer the need to demand such a premium, and therefore the things will be different. So my conclusion is as follows. The transition towards an emissions-free economy is affected by diversification motives. They're initially, diversification and climate action are initially complementary goals. But however, after a while, the two goals become conflicting and a trade-off arises. I I think from a policy point of view, these findings are challenging, and maybe they're also from a theoretical point of view challenging, because initially agents should be intrinsically motivated to take climate action simply to reach diversified asset holdings, but over time, policymakers want to incentivize agents to cut the carbon discount stock beyond its optimal share from a purely finance point of view, and then they must counter the positive effects of diversification. I think this type of papers are only the beginning, and I'm sure for sure not one of the best persons to do. You need good finance people. So I particularly like the work of Michael Barnett and also Steffen and a few others who are doing this work. But I expect a huge explosion of this type of stuff to come out in the coming years, because it's really what's about. And what people are particularly interested in is, of course, which I haven't touched upon today, is suboptimal policies, or policies where you have fickle governments. They may have policy risks suddenly changing. They may also have risks of breakthrough technologies. So the same thing that suddenly a government steps up climate action is of course identical to a certain probability of a breakthrough in renewable energy technology. And all of these things will mean readjustments of the economy. With these adjustment costs, they will lead to stranded assets or reevaluations of these assets, also in the stock markets. So I leave it at this, and thank you for listening.
Okay, thank you, Rick. Very interesting. And of course, we have a couple of minutes left. So if there are any questions, we have time for that. I had some questions about policy risk, but I think you addressed them now in your conclusions. And maybe you said it, but like the standard model, I would guess that it depends slightly on what climate sensitivity you would use for the size of the damages also. Yeah. So the IPCC would say there's a huge interval, maybe that if you take the highest values, for instance, wouldn't that give you similar effects to, yeah?
Well, we have, in a sense, we've made it stochastic, the response of temperature to cumulative emissions. Mm-hmm. And in a sense, that should be picked up in the whole optimization exercise. We could do that better, because I think we have additive uncertainty, but we could have multiple uncertainty, and then that will be definitely an effect. I've looked at that, of course, in other papers with Ton van der Bremer, where we look exactly at that type of uncertainty, and that's a huge driver of climate policy. Mm. Coming back on that policy risk, personally, I think what we should be thinking of is that you have election risk, where you get different types. Think of Australia, think of America, where different governments have different ways of dealing with the transition or not dealing with the green transition. And then you could just basically have it's like a tipping risk, except the tipping risk is not a climate tipping risk, but a political tipping risk. And where the probability of tipping may depend on all kinds of electoral considerations. So we have the tools and means of doing that. But definitely people like Kai and Lonsek, but even people who maybe not so computationally challenged can make a fair go of that. And I think that's probably the way we should. I think that the weakest bit of this literature is perhaps, and people like Tim Besley and Thorsten Persson are going that direction as well, or at the political economy aspects of that. And that's, of course, when you're trying to get out of coal into some renewable energy, you cannot talk about it without vested interests, without status quo lobbies, and without electoral considerations. So when I look at the literature, including my own papers, but particularly, just overviewing the literature, being an old man, I think that's really what we're not doing very well.
Yeah. So I don't know if we're out of time or not. Steffen has a question, but it's up to the host, because we're basically out of time. But
okay. So yeah, first of all, thanks a lot for referring to our paper and presentation quite a bit. So that's, I also think this is an exciting area. My question is, because you're highlighting this diversification channel, right? So I don't really know how to think about it, but would there be a way, maybe you have an idea, to also shut down in one variant of the model the diversification channel? I mean, I actually don't know how you would do that. Maybe you have like some fixed capital or some additional type of adjustment cost, but just to highlight, because we have here this trade-off between the diversification channel and the other effects, and just to highlight this a bit more, how much actually each of the channel explains. So I don't have a direct idea, but I would find that very interesting.
So that's a very good point. So we have, in a sense, two types of correlations. So we have the correlations because of the jump risks and because of the geometric Brownian motion. The jump risk is the main one that drives everything. But we could set it up so that they're less common or even opposite, or we could play with that and then illustrate exactly those issues. I feel that we should do that more, and I should have presented that to you today. But that's I think that's exactly what's needed. Yeah. So, but that's the way I would do it. So by playing around with these correlations between these jump shocks and these geometric Brownian shocks between the two sectors. So,
yeah, that makes sense, right? So depending on how they are, you might have less or more diversification benefits, and this would be a way to look. Yeah, and that would be very interesting to
and it might even go the other way around.
Yeah.
So we're doing that at this point. There were some computational issues, but we're getting there. So but I should have presented, because I have some preliminary stuff, but I didn't put it on the slide.
Terrific.
So that's good. Thank you. That's a good point.
Okay, thank you. So thank you everyone for contributing. It was a great session.
Thank you, Conny, for organizing it.
Yeah, it was also Tor Jacobson at the Riksbank was part of that as well. So thank you.
Thank
Bye,
you
everyone.
Bye-bye.
Thank you very much.
Bye.
Thank you. Bye.
Bye-bye.
Bye.